Today's market call is presented by CME Group, where risk meets opportunity, and FactSet, financial data and analytics powered by tomorrow. Laird Hamilton is a badass. Those commercials are badass.
Well, let's give some context, okay?
So people, what context?
CME Group.
What context?
They
CME Group, where
TV
risk
ads.
meets opportunity,
Correct.
and then you have you watch the television.
Yeah.
And if you're watching TV on like your computer or your phone,
well, the kids today,
I
that's
don't
what
give a
they
shit
do.
about the
They
kids.
don't
I
have
don't really
they don't
care
have
about the kids
TVs.
today.
Wait. So this is market call. It's May 30th,
Yeah,
and
it's 1
usually you'd
o'clock.
say the month has just went like that.
It does. It flies by. 30
Yeah.
days has September, April, June,
Yes.
and November.
Yes, it
so
has.
today's this penultimate day.
The second to last day. But
by the
Laird
way-
Hamilton is like a world-renowned surfer, and he
he's
happens to be in the CME Group
Complete badass.
ads. Yes.
Okay, we're going to
That's
talk
the
about all
context.
this. Bill Hochman, by the way,
Oh,
Bill hears me.
Don't even.
Yesterday, we were looking at my Spotify playlist.
Yeah, it's called your library, but for some reason you call it a playlist. It's your library. You literally have 900 songs on there.
Yeah, I don't know what that means.
It's not a playlist. A playlist would be curated in a way that,
Yeah,
you know what I mean?
curated the
Yes.
songs that I like.
Yes.
That's curated.
Okay.
But he said about my playlist, because apparently he went through it. He's like, "You're such a poser, dude." I'm paraphrasing. I'm like, "What the fuck are you talking about?"
Yeah.
And he's like, "How can you not have Dancing in the Dark on it? How can you not have
that? He didn't say that. The
Glory
worst,
Days?"
the two worst Bruce Springsteen
That's what I
songs
told
in
him.
the
He
entire
disagreed.
catalog. And
then we went back and forth.
All right, well, follow Bill Hochman on the Insta.
No, he's a comedian.
He's a comedian.
So maybe he was trying to be funny last night.
He hasn't said many funny things.
Well, that
here.
was funny.
Okay. All right.
Let's go to the rundown
Let's
because
do
we
it.
got Carter Worth today too.
Waiting in the wings.
Typically, if it's Thursday, it's Butters, bitch. But we
Yeah.
did it yesterday.
Yeah.
Here's the rundown because why not throw
Yeah.
this thing up? S&P cresting.
Yeah.
We haven't used
Well,
that word in a while.
Carter
And it's
is-
funny we're using cresting because if you think about it,
Yeah.
waves crest.
Yes, they do.
And Laird Hamilton
Correct.
is a surfer.
And
It's
we
actually
didn't-
all makes
we didn't even
sense.
know that was happening. But Carter brought some really great charts. He actually maybe he's going to have the results of his one question poll that he had out on Worth Charting. Sent that out.
Was that the Rangers going to win tonight? Is that the question?
No, it's about the
Game
S&P
5,
500.
by the way, tonight.
Can't wait.
Best of 3 series now. Home ice. This is what you.
They got two at home. They got two at home.
The way it all season.
This was interesting, guy. Retail divergences. We've seen a bunch of them going back to Walmart and Target. We have Costco after the close. We're going to preview that a bit. But on a day today where we're seeing Best Buy, I wasn't so sure about that quarter. It's up a bunch. Foot Locker's up a bunch. Kohl's is down a bunch.
Dollar Gen's down. I mean,
Yeah.
we had some Cat Hubert last night.
Oh yeah, he was good.
I liked him.
He was the former Best Buy CEO on CNBC.
He had an
Fast Money.
accent. I mean, people sound. I have an accent, but I sound like a dope.
Yeah.
When you have a European
True.
accent, you sound really smart. And
Here's one. This is you're gonna like this guy. Amanda's not even here this week.
This
She's on
who wrote
vacation.
that?
I did.
That's pretty good.
I know.
Enterprise stocks feeling sassy.
Yeah.
See what you
we
did
did
there?
that.
Yeah.
So we're gonna
Software
go,
as a service.
We're gonna get into that. Let's bring him in.
And Dell and Costco earnings
Carter
preview.
Braxton Worth
Yeah, bring
here
him in.
of Worth Charting. Guy and Carter, welcome.
Man,
buddy.
what's up?
Yeah, looks
Hey,
good.
weird day. I just want to bring this up. Okay. So on my fact machine, my main screen, I have all these sectors, like categorized, I have like,
Sure you do.
so I like to look at my main screen as a bit of a heat map, right? And on the
Mhm.
left, I have a lot of software. I have some enterprise hardware and I have some internet. And it's pretty much all red. And then I look into, financials, some retail, some pharma, some industrials. It's all green.
Mhm.
And then I look at where the indices are trading, and I have the S&P futures, the E-minis down about 0.25%. I
Correct.
have the NASDAQ futures, the E-mini 100 futures down a little more than 0.5%. Kind of weird.
Well, I'll throw this up.
Yeah.
The Russell
Up.
is up 1.25%.
Kind of weird.
And now you have the VIX down below 14. So yeah, there is a lot of
A lot
there are
of weird
strange
stuff.
things happening.
Carter, are you seeing just anecdotally? Are you seeing a lot more divergences in your work in the charts that you look at?
I mean, what's interesting is that today is a very broad day in terms of advanced decline, about 350 S&P up, 150 down. And it's only two sectors that are down are the big ones, right? So it's telecommunications or communication services, which of course is no longer AT&T and Verizon, but it's got Google and so forth and Netflix. And then it's tech itself. So you have every other sector up, as you guys mentioned, Russell, for instance, being up, small cap is up. So it's a really mixed bag. And we continue to have the circumstance where the key names that are such a dominant force in the market, representing 30%, the top 10 names are so important to what lies ahead. At some point, their outperformance is so extreme, and we'll look at some of these charts later. But it's a very curious day. The headlines, the indices are down. Many more stocks are up than down.
Well, let's look at our S&P E-mini futures chart, and then we're going to go to yours. Ours are pretty, they pale in comparison.
He just said what lies ahead. I think this chart speaks to what lies beneath. You see that moving average there, how it's gotten back to that kind of gap fill breakout level, that sort of thing here. And, I think what I'm in your head a little double top there. Is that what you see?
Look, you know what I feel about that. I mean, it appears as though, things are starting to roll over for sure. So that's our chart. And, you could see the relative underperformance over the last couple of weeks. We got those prior highs. We obviously traded off significantly in April, bounced back. Here we are. We'll see. Let's look at your charts, Carter, because you do such a better job than we do.
Well, I'm not sure that's the case, but I like the optics of mine. I think colors are good. Yeah, but here we go. So let's toggle here. Let's just go 1, 2, 1, 2. Look at the next chart. Let's go back and forth, back and forth, back and forth. Here we go. Now let's stop and start. Okay. So S&P 500, first one. The simple, the first chart, S&P 500. Now, actually, I've this is an error. Those have been annotated. They're titled. One is the actual S&P, which you're looking at here. Okay, so we know it's above. It's late 2020. The second one is the equal weight. It doesn't show that on the title. Equal weight. So look at the second chart. That's the equal weight, and that's the real story. Right? The equal weight is still not really progressing from where it was. Almost two years ago, more than 2 years ago. So the question is what to make of that. That peak was essentially January of 2022. We're now June of 2024. So 2.5 years ago, the equal weight S&P 500 is still stuck at its former all-time high. And so let's toggle them again just to show the true juxtaposition. The first, how much above, and then the equal weight. Again, apologies, I haven't titled that correctly. And so now let's look at it another way. Let's look at a comparative chart. And so here is, this is important, right? The comparative chart shows it a different way. We've got a pretty wide spread. And the only other way you can do it, of course, is look at a relative chart. I believe we have that here as well. And, this would be, okay, well, this is a different subject. This is the outside reversal day that was in effect. And so the last time we saw that, of course, was in the March period. Market ended up selling off about 7%. And we'll see if we follow through to the downside. That's my hunch, hence the annotation and so forth.
So the reversal days are interesting. And, we talked about and I'm glad you brought those up because we actually brought up the single stock in the form of NVIDIA on that reversal day on March 8th. And that actually worked because if you remember, the stock went sideways for a while, then cratered in April. Then you and I had a conversation about the importance of it. And you said, given the fact that it had recovered as well as it did, it no longer had the same import. And obviously you saw what NVIDIA did since then. But this is obviously different in the form of a more recent reversal day. And you saw what happened the last time. But go back to that prior chart, which shows the underperformance of the equal weight now. And it's juxtaposed with obviously what the S&P has done. They historically trade in lockstep. Something's got to give here, right? The outperformance of the S&P is significant recently. So I'm leading the witness without question, and the defense attorney might say, I object, Your Honor. That's fine. That's his or her wants to do. But how does this reconcile itself in your opinion?
Yeah, so interestingly, it just depends on and is always the case, where you start your narrative, where you start the meter running in the cab, so to speak, which is to say, if you do this from 1999, the equal weight is literally crushing the actual S&P. And that's a function of the big heavy names like Cisco at the time, all of which lost so much money. And so it is where you want to start your comparative chart. But the issue now is that there is a concentration function in the market that is either the thing that keeps the market going, because these are such unique and remarkable dominant companies with cash, with moats and so forth, or it's just the opposite. Too many people believing in a few things. And every day you have an American Airlines that crashes, and a Kohl's that crashes, and a Workday that crashes, and a CRM that crashes, and that something has to give.
Yeah, we're going to get to some of those things in a little bit here. The things that a lot of people believe that's getting narrower and narrower, and we're losing I think, some of the pillars of that kind of bull case. Let's get to that. You did a single question survey. This is among your Twitter followers, among your Worth Charting subscribers, and then obviously your institutional clients. You don't do these too frequently. Talk to us a little bit about the findings of the results here.
Yeah, so it's a relative strength chart. That's all it is, right? It's looking at the as opposed to a comparative chart, the performance of the equal weight S&P to the actual S&P. And those sort of low points, interestingly, coincide with market peaks or market tops. So one could say, well, so which is it? Well, that's the point of doing the poll, because different people see different things. But if you look at the swoon, meaning the moments at which the relative performance of the equal weight is particularly extreme and poor to the actual, one of them in 1990 was a market low. That was the recession, and equities went much higher. In 99, 2000, that extreme reading in terms of the equal weight to the actual weight, it was a market peak. Of course, we know that stocks went down from 2000 to 2003. And then, of course, you see the financial crisis low, also a blue circle. That was a time to buy equities. Then you see the COVID low, annotated. That was a time to buy equities. And here we are again. And so we have the overwhelming response was that this was a market peak. We might have the results here on the screen, but if we don't, a lot of people say it's irrelevant, and that's fair. This is how it sort of came out, what you see here. So people interpreting the current extreme reading in the underperformance of the equal weight S&P to the actual S&P. You see the difference between Twitter, but basically the dominant answer was that it was a market peak. So one could say, great, perfect, let's be contrarian and say it's not. Yep. This is the nature of polls.
No, it is pretty interesting to look at, and I love the relative strength, one versus the other. And again, I think sometimes we ask you to kind of explain those things, and you did it pretty well. Some folks just don't think of things in relative terms, but it is an important way to think about it. Really quickly, let's go back to the 1 year E-mini chart. Guy, I'd love to get your sense on some levels here, and maybe Jacob can get ready the intraday chart here. So I look at this thing, and we started out the week, Guy, talking about how it looked to be making a consolidation above those prior highs, making a little bit of a flag. But you see now it's come off nearly a couple percent or so, and it seems to be, kind of lagging out of that flag. I don't know if that's a real term or not. So if I'm thinking about this, and let's pull up the intraday really quickly. So, if you just look at it like that, it looks like it's cresting. That was the term that we used. So on an intraday basis, let's just go to 1 year or 1 day for a second. You see that we're basically near the highs. We overnight got down to 52.50 in the futures, and here we are 52.70 or so. So 20 handles, Guy. If I'm thinking about this now, let's go back to that 1 year chart. That prior high, it was like 53.25 or so. If I'm looking to play, lower in this thing for a retest of those lows from, let's call it April or so, I might look to sell the futures here. Let's see if they can't really get ahead of steam today, Guy. I would be selling them at 52.70 or so. I'd probably stop them at 53.20. Or about 40 handles or something like that, because if it gets back towards those highs from early April, it might be on its way to making new highs, and then I would continue to lower my stop if it continued to go down. What do you think of those levels?
Well, the levels make sense. I mean, you're effectively, I think the prior high was 53.40-ish or so, but it doesn't matter. I mean, I see what you're doing without question. What you're saying is basically, if it were to get to those levels, it's probably going to keep going for whatever reason. Tomorrow you got month end. I don't know if you have some rebalance or reweighting tomorrow, but you also obviously have this huge, the PCE number, which is the Fed's preferred measure of inflation, as Elizabeth Young would say. So we'll see what happens on the back of that. Obviously today, on the back of some weaker GDP, you saw yields back up a little bit. I think 10-year yields are down about 6 or 7 basis points to 4.55. So you have a lot of cross currents here. I'll say again, I still think yields go higher. I think yields go higher probably on the back of that tomorrow. And these month ends, you can see some really strange things. So I think the risk reward at least makes sense, because you know what your stop is. And again, if this thing starts to work for you in a meaningful way, what you're going to basically do is put a trailing stop on the short position. So it makes sense to me.
Before we get to a couple more charts, Carter, and we'll let you go, we want to hit some of these kind of macro themes really quickly. Maybe Jacob can pull up this tweet from Carl Quintanilla. You just call him
CQ
or Q. This is from Ed Yardeni. We still see no reason for the Fed to lower rates. Why cut rates when the economy is doing just fine? The Atlanta Fed's GDP Now model shows that the GDP tracking at 3.5%. That's for Q2 right now. So to your point, we came in at 1.3 for Q1, less than expected. Real consumer spending up 3.4%. So what's interesting to me about this guy, and again, I'm not opining on what Yardeni's reporting or not, is that, expectations for growth came in below expectations, okay, for Q1, but then you have many bulls, pointing to the fact, well, look at how Q2's tracking. And we know that the GDP Now is not that great of an indicator. So thoughts there, Guy, because I know that you feel like rates should not come down. But again, I think it's interesting for someone like Ed Yardeni, who's seen almost every rate cycle over the last 50 years or so. I'm not calling him old. I'm just saying he's done it. He's been there. I think you guys are in agreement on the rate thing.
I respect this. We're in agreement for different reasons, though. I mean, I think he thinks they shouldn't because of the economy. I think they shouldn't lower rates because inflation's still a problem. And I think, we can debate that, but we both come down on the same side, from different, we're coming at it from obviously much different angles, but I agree with them. I don't think there's any reason to be lowering, again, I'm hard pressed to understand why the rush to lower rates when things are seemingling working in your favor through a number of different lenses. Like, it just doesn't make any sense to me. So that's
I guess the one issue would be that the higher for longer, the long and variable lags of higher interest rates, again, versus, an inflation rate that's 3.1%. If you have a Fed funds at 5.5%, that's not that restrictive for all intents and purposes. I think that's a case that you would make. Carter, let's rip through a couple charts here really quickly.
Sure.
Let's look at the 10-year U.S. Treasury yield. These are our lines, not yours. Simple uptrend here. I know that, at a time, I know that you don't like narratives like higher for longer once you start hearing that. I mean, we tried to line this thing up pretty decently. We were talking about it yesterday. Let's just say you believe in our uptrend channel. It's not, precise or whatever. But if we got to the higher end of that, you're looking at almost 4.75 or something like that. The prior high was 5%. And we know that when yields were at 5% in the fall, the S&P was at 4,200. Thoughts here?
Yeah, I mean, this would for me be more than anything a pair of twos. We all sometimes are prone to a bias. My hunch again is that rates are not going higher, in the sense that when that nomenclature, that higher for longer, that there was talk of 6% and 7%. All those voices have gone silent.
Not really, though. Hold on a second.
Jamie
Dimon this week. You know what I mean?
What did he say? 7?
No, he said he looked at a crowd. Was it a Bloomberg conference or something? It's like, you guys have never seen 5, 6, 7% or something. He's been saying that for a year, and I got to tell you, man, I'd rather take his word for it than a bunch of yo-yos on Twitter. And I don't mean, I'm not speaking to you. I'm just saying in general.
Sure, no, I get it. But I guess at the end of the day, with all of the inflationary pressures that we've seen, and it continues in rents and it continues in commodities now, especially in other things, I think the burden of proof is on the higher rate view. We're sitting here at 4.5%. It isn't gone higher. Yeah. Now, at some point, this has to get resolved, and maybe it's much higher. But my hunch is that is not really what's likely.
No, listen, all fair. I mean, there's a very compelling reason to think yields will go lower. I mean, again, if you still see soft data, it makes sense that yields would go lower. On the flip side of the coin, Dan, the last couple Treasury auctions we've seen have not been good, and that's not me grading them. That's people like Peter Bookvar and Rick Santelli, who actually understand these things a lot better than I do, and yields moved accordingly. So you have a supply-demand dynamic with going on. You obviously, again, we hammer Japan all the time. Dollar yen backed up a little bit today, which is probably good news. But, all those factors are still in play, which suggests yields can go higher.
Well, it's interesting. So let's pull up the Dixie, the US dollar index. And I think this is interesting as yields have kind of moved higher over the last week and a half or so, from 435 to it got as high as 463 yesterday. The dollar's kind of stuck here. And it's kind of holding that moving average. Carter, thoughts? Because I'm sure you feel very similarly. If you just look at it on a 1-year basis.
Yeah, I mean, there's just nothing to be done. That's often the key, is to keep your money in your pocket rather than putting it out into onto the track, so to speak, making a bet. There's just no bet here that I see.
And crude oil guy, this one again, it's kind of banging around.
Seemingly got off at, it seemingly found support levels where it's found support before.
Yep.
We're right at the moving average, so it's this tug of war that continues to go on. On the one side of the equation, I think people will look to, again, slower economic growth suggests that crude oil goes lower. The flip side of the equation, geopolitical risk, potential things out of OPEC, still some supply demand imbalances that are out there. People think it's going higher. Carter will tell you, though, correctly, that when you get this euphoria around higher prices, that's typically the top. And we have everybody talking about, crude's going to $60 again. That's typically the low. And then we find ourselves effectively smack in the middle of that range.
Yeah, it's smack in the middle
Yeah.
there too, right? I mean, sometimes things do actually, they're at the price they belong, right? A house isn't always undervalued or always overvalued or expensive. It's same thing with, sometimes you go into the store and what they're charging is the right price. The same thing for a rent-a-car. Crude oil probably belongs right here, and there is no discernible opportunity on an immediate basis to be long or short.
Yeah, I guess the only thing I'd say is, like, last year we did not have a 10% plus sell-off, right, in the stock market. I think this is also, we were tracking this data like a couple months ago. I don't even know where the hell it is right now, but I think you have to go back to February 2023. The last time we had a 2% sell-off in one day in the S&P 500. So yields don't have to go that much higher, in my opinion, to kind of shake some folks out of the S&P at 5250 guy, right? We're 1,000 points above where we were, again, when the yield on the 10-year was last at 5% or so. So it wouldn't take, too much of, let's say, economic growth data firming, you know what I mean? And then higher inflation readings, because that actually comes with higher than expected growth. Like, that's the whole point why the Fed started raising interest rates, to cool down the economy, to cool down the housing market, to cool down economic conditions, right? Or financial conditions.
Yeah, a couple of GDP prints ago, we got a glimpse of, I think, what's going on. We saw, obviously, weak GDP in the form, I think it was 1.6%, which was much lower than the market anticipated. But embedded in that were some pretty hot inflation numbers, which got a lot of people talking about the stagflation, which I think prompted then Jerome Powell to say he sees neither the stag nor the inflation part of it, which pissed a lot of people off because it's staring him in the face.
Yeah.
But again, we'll see. It's out there. People are talking about it. Danny Moses brought it up a long time ago, the potential for this to happen. I think to dismiss it just completely out of hand, I think it's I don't think any of us are doing that, but I think it's somewhat foolish. So there's obviously one component of this that has to basically move, and that's obviously the unemployment rate. If you start to see a tick up on the unemployment rate, I think that's what's going to give people some pause in the equity market.
Yeah, no doubt. All right, Carter Braxton Worth, we really appreciate you being
You
here
bet.
with us. We
See you
hope you
guys
have a
soon.
great weekend. We'll see you, I think, next Tuesday. So
We're
Okay.
back to normal schedule.
yeah, be well. All right, guys. Like, going back to how we started the show, kind of weird price action in the market, really kind of focused on the NASDAQ. Let's pull up the NASDAQ 100 E-mini futures here, because this one is kind of interesting, right? It made that new high. It looks very similar to the S&P 500 E-mini futures, but it sold off more than the S&P 500 and it's rallied, I guess, more back. But it's really focused on something that you and I have keyed on a lot. And if you want to actually have more of this conversation or listen to more of this, yesterday, or it dropped this morning, but yesterday we had the conversation, you and I, on the OK Computer podcast with Deirdre Bosa. She is the host of CNBC's Tech Check. And we covered some of this kind of divergences that we're seeing on this AI trade. We obviously talked about the concentration. Dell, we're going to hit that in a second. Reporting tonight will be kind of interesting as one of the ancillary sort of plays as far as generative AI. But the NASDAQ futures, it is what it is. I mean, like, we get it. Like, even off of the recent highs, guy, it's hanging in there better than the S&P 500.
Without question, predicated on all the things, everybody seems to talk about on a daily basis. And that is great, obviously, but we're going to talk about some things below the surface that are not so great. Yeah. So look, here we are again. I'll just emphasize that for the fact that we are nowhere near the moving average. I mean, that becomes a mean reverting thing. Now in April, it appeared as though we were on a beeline to that, and we stopped, I think, in large part because effectively the S&P stopped at its moving average. But with each passing day, things get more and more extended and more narrow in terms of what's driving the bus here. Regardless of what you hear about sort of broadening out, it's really not happening. It's actually going the other way, seemingly.
Yeah. So let's look at the Salesforce.com CRM. Maybe they can pull up a live chart right here. And this is down 20%. You and I were on Fast Money,
which is incredible.
Yeah. So I mean, give me your 2 cents, because last night I think you and I were both surprised relative to what they missed in the current quarter and what they guided to. But it's really this billings growth, 2%.
And I said that last night on the show that going through the numbers, I didn't think it warranted the move of this magnitude. Again, I mean, it just didn't seem, because the guide was not great, but it wasn't catastrophic.
No.
We've seen much worse. But I think in retrospect, listening to some of the commentary, there's obviously this concern that in a zero-sum world, if people are spending on AI, they're not going to spend on the software component, right? It's just dollars are not going to go there. And I think if you listen to some of the commentary, the growth suggests that it's exactly, or the lack of growth, I should say, in Salesforce is exactly what's going on. So that chart doesn't look good. You have a huge island reversal here.
Yeah.
And if you go longer term, Jacob, real quick, we talked about this. I remember talking about Salesforce in the middle of March saying, you know what, you might have just put in a pretty massive double top, and that actually played out. So here we are at the moving average. Here we are with a huge volume day. We theoretically should be at a huge support level here. And I mentioned 220 last night. We're obviously trading 215, but here, this is your bogey right here, Dan.
Yeah, so this is just fascinating to me. This is not a small company.
No,
yet,
I mean, it's a $200 billion company, right?
Yeah. This is a company that's been talking about how they're going to use generative AI across their own platforms and their customer offerings and everything for over a year now. And look at just like how the concentration of the trade in like an Nvidia and a handful of other names. I mean, this stock, its market cap is half of what Nvidia has gained in the last week. And so the fact that people are not paying attention to, and we have, we'll go through some other numbers in a second here. The fact that people are not paying attention to. Oh yeah. Well, Jacob, pull that up. You got that. I'm sorry, I didn't see that. So let's just look at what's going on in the software space today. Okay. So you made the point. So if you're, a company that's offering licenses for software for seats, it's been a great model. It's been recurring. People are willing to assign, a big multiple, right, to those sorts of things. Then, it's been a great trade. But why is it, Guy, that all of a sudden these stocks have just become derailed as people have become more focused in generative AI? That's the question you should be asking here. So let's just look at the performance. This is just today, people. Okay. And you can look at the year to date in the far column. So we have the price, we have the dollar amount that it's down, then we have today's price action, and then we have year to date. Okay. So Microsoft's up 12%, but it's down 2.5% or so in sympathy with Salesforce. That's important. Microsoft has been one of the hugest beneficiaries of generative AI. And you can go down the list. We're going to talk about Dell in a second, but Dell down in sympathy. Workday's been a disaster. Look at ServiceNow down 10% on the back of a Salesforce number, and then go down to Snowflake down 28% on the year. Team, which is Atlassian or something, I don't know how to pronounce it, down 30%. So talk to me a little bit about what I just said, Guy. Is like, if you're not paying attention, this Adobe down 24%.
So it's a double whammy now. I think, again, just my opinion, the double whammy in the form of, one, the spend is going to AI, and maybe the spend and the growth is not going to software. Without question, I think that's part of what's going on. And the flip side of the coin is the investment dollars are going to AI and basically if you semi-related names and not going into these names. So not only are they missing it on the investment side, they're missing it basically on the spend side of the equation as well. So that's not a healthy double whammy. And these are all under pressure, and I think correctly so. Now, they will all find levels, and Dell's going to be interesting today because Dell's is sort of a bit of an outlier here, more of a hardware thing. So we'll see. However, that's what I think is happening right now.
All right, let's go to Dell for a second. Let's look at the implied move in the options market. It's about 13%. You see that gap?
Big.
You see that gap from 3 months ago where it broke out to new all-time highs? That was 31%. Okay, so when you think about 13%, we talked about it on Fast Money last night. It was about 10.5% last night. So it's kind of moved. Okay, there's two reasons. Obviously, the Salesforce is a big one. We're going to talk about Hewlett in a second. And, it's given back a lot of yesterday's gains. I just, to me, Guy, it just seems very unsustainable. We talked about it in OK Computer. This is a company that's growing earnings and sales at high single digits, maybe at best 23% gross margins, trades at 22 times. It just does seem expensive all of a sudden. It might not have seemed expensive, 6 months ago or 9 months ago. It does right now, especially where we are in the cycle.
We had Ben Reitzes on in the fall. So I think in October, and he talked about Dell. He thought it was a double, and it was a $65 stock at the time. He wound up being correct, and we had him on recently, probably a month and a half or so ago, and he still liked the name. Now, that was spot on. The problem, not that there's a problem, but the issue that I have is the magnitude of the move suggests you're going to get some pretty violent back and fills, which is not an indictment, again, of Dell. They probably found themselves in the right spot at the right time. But again, a miss on any basically magnitude, even if it's infinitesimal, is going to get these names are going to get punished. So it's had a huge move. It's given a little bit back today, which maybe is a good thing into the number, but I'd be leery here. Like, if you can take some money off the table, understanding that you might miss that move to the upside, but I think it's sort of 65-35 against you at this point, given the move.
Yeah. So think about this, about a $20 move in either direction. That's what's implied. So if you were to buy the at-the-money call or the at-the-money put, it would cost you about $10. I mean, I think this stock is going to move at least $10, guy, between now and the end of the week, which is what you were saying. But you got to be right in direction. Otherwise, that premium goes poof. So it's a little binary. All right, guys, look at this one. Not a name that we've talked about a lot lately. This would be HP. And they're basically calling the bottom in PCs. We have not heard that. We've heard that PCs, and we know that smartphones have been very weak for a while here, but the upgrade cycle in PCs centers around this focus on generative AI, being used on hardware devices. You need to upgrade better processors, more memory, all that sort of stuff. I just don't, I don't buy that just yet. And I'll tell you why. Because I think a lot of the services that a lot of consumers are going to be using for generative AI is going to come from the cloud. Okay. So it's not like you're going to be doing all this work on your hardware device right now. So thoughts here. This is one that obviously ran into the print. So there was some enthusiasm about the potential for this. You see that flat 200-day moving average. You see a move like this. I don't think this stock has high short interest.
No.
But this is not anything that you chase. And I just want to make one last point. I looked at Karen Finerman, who I love to death, on CNBC's Fast Money after that Dell print last quarter. And you remember she says she's buying more. She was long into it, and afterwards, and she was right.
Yeah.
You know what I mean? Like, so, but you know what she said last night? She's selling calls against some of that position. And that's what I think you're speaking
Which is the right thing to do. In terms of Dell, yes. Let's go to Hewlett Packard real quick. So today it's already traded 22 million shares, typically trades 7. So it's on pace to do, I don't know, maybe 5 to 6 times normal volume. Number one. Number two, longer term chart, Jacob, if you can, because you'll see the price we're trading at now is hauntingly familiar. It was actually June 2 years ago that we traded up to basically $40, $39.5, $40. So if you look at a longer term chart, you're going to see, again, we keep hammering these double tops. Well, there you go. So these levels that we last saw and failed at a couple summers ago. So if you've enjoyed this move, I agree with you, by the way. I think there is going to be this PC upgrade cycle, but I think the market's getting a wee bit ahead of themselves in terms of when it's going to happen.
Yeah, last thing.
By the way, Jim Cramer talked about this a couple of weeks ago on his show, the mother of all PC upgrade cycles. So we'll see how it plays
part
out.
of that was that Microsoft just held this build conference, and they were talking about their hardware, and they obviously have 13 billion reasons, and probably many more, their investment in OpenAI to talk up why you need to upgrade your hardware to use these sorts of services. Really quickly, Hewlett is a 42% gross margin company, is trading at about 11 times this year, 10.3 times next. So it's kind of cheap. The only problem is you only have single digit expected growth. So it better be accelerating a great deal to chase this sort of thing. But I would almost wait and see, how does this stock shape out, especially, or sort out after this big run, especially if we continue to see pressure on enterprise spending, because ultimately that will flow through down to the hardware.
And there's a factor that nobody seemingly talks about. I mean, everybody wants to drive a Ferrari, but very few people can actually drive them properly. And I only mention that because everybody seemingly wants all these bells and whistles and stuff, but how many people really truly know how to use them properly? And I think we're still a ways away from that. So as much as you want all these cool new things, is it user-friendly stuff? I mean, maybe somebody for like you who obviously understands it. I don't know if that's necessarily the case across the universe of users.
Well, really quickly, I mean, if you're a consumer and you want to pay $20 a month for ChatGPT, or you want to pay $20 a month for Gemini or for Perplexity, you do not need to upgrade any of your hardware.
Well, that's
Like,
the other thing.
so think about it that way. I mean, it's cloud based, and so again, until the hardware gets that much better and they can make the case why the experience is that much better, I just don't think we're there yet. All right, Guy, really quickly, because we got a few more things to get out of here. Retail, some divergences there. Let's go back to the Walmart Target from a couple weeks ago. Walmart blew the doors out, broke out to a new all-time high. You were in that kind of camp. You thought that consolidation, and you thought their inventory problems long behind them, their exposure to grocery and the like, and the trade down, all good. Target, you were also in the negative camp here. You had that huge gap. That's a good little one, but that is what it is. We've beaten that one to death. Today, you have Best Buy up. You have Kohl's down. It really interesting sort of price. Not that these companies are particularly similar, but I'm just curious, what is this saying to you about a consumer?
Well, I think, we talked about this last night again with Hubert Jolet, and we talked about how you have to be a really good operator in this environment, and you're going to be rewarded if you are. And the flip side of that coin is, if you find yourself in no man's land, and he didn't think Target was there, I do. It's a very difficult place to be, but throw Dollar Gen in the mix as well, DG, and look at that stock today. I mean, I think it's down, want to say today, it's down 6%. So I was right, I guess, but I was right. And this is a stock obviously that hasn't performed particularly well for quite some time. So you would think that dollar stores would be doing really well in this environment and doing anything but. So Dollar Gen had a big move from the fall, traded, I want to say, from about 102 or so, traded up to north of 140, actually north of 150. Now we're starting to give it back again, which actually makes sense to me. So I don't know. I mean, this to me, everybody wants to talk about the strength of the consumer and stuff.
Yeah.
When you look at certain places where the consumer should be, they're not. That doesn't speak to a healthy consumer,
right,
in my opinion.
Which brings us to Costco tonight. After
which is going to be really interesting.
Implied move 4%. That's about $32 in either way. And go back 3 months. Look at that gap from an all-time high. Then it sold off like I think 7%, which is a massive move for Costco. And so you're telling me that things have changed that much in 3 months? You know what I mean? One way or another after a move like that. This one makes me nervous. If you have a directional inclination, the idea of buying an at-the-money put for 2% of the stock price seems kind of fair to me. Thoughts?
Well, it went from 800 to 700 in almost, not I want to say a straight line, but over the course of basically a couple weeks of trading. Now we're making an all-time high today into this print. That scares the shit out of me. Now, we have talked about Costco forever on Fast Money. They do everything right without question, but there have been periods of time where the stock does sell off. And you can look at this chart for just proof positive. You want to go back and look at the move in December of 23 into basically late to mid-January of 24, the same type of percentage moves. And I think we're on the cusp of something like that again. So I think it's, again, I mean, we'll walk in tomorrow, not that we're doing the show tomorrow, but we can walk in March an $850 stock, and I'll say I was wrong. I'm hard-pressed to believe they're going to say things that make you want to stay or buy the name yet again.
All right, I agree with that. All right, we have two things. One that's not in the rundown that's going to be a lot of fun. Just
hockey.
Bear with me for 1 minute. I want to hit the CME Fed Funds tracker here because, again, Guy, I think what's interesting here is that we started this year. There was a lot of optimism about the stock market, about the economy, and really buoyed by the idea that rates were going to come down pretty aggressively. All year long, that's been pushed out. So here's July, 80-some percent, 88% chance that nothing done. Okay. There's still a 12% chance. But again, I think you and I will agree that that's not likely. September. Okay. There's a month and a half, I guess, before the election. Let's just call that 50-50, right? Of a 25 basis point cut. And then we get to November and you see that the likelihood, or at least there's a 47% probability that you get a 25 basis point cut by then, or maybe that's 50. And then there's a 35% that it's 25. So expectations are kind of working their way to a 25 basis point cut. It won't matter. The markets are not going to move off of that unless they really signal something. But you don't believe that if they start cutting aggressively, that's going to be good for the stock market.
No, I don't think so at all. I actually think, and it's funny, you just said something like, you don't believe it's going to really make all that much difference. I agree with you. So if that's the case, why would you do it, especially ahead of an election where it's going to get politicized? Like, why put yourself on those crosshairs? And they'll say, we're not a political entity. I agree with that. I mean, if that's the case, so there's not right now on May 30th, there's nothing, in my opinion, there's no compelling reasons why they should be thinking about lowering rates this year, especially given the fact that it's an election year, especially given in terms of what the market is looking for in terms of dates and months. Like, just stay away from it. Keep yourself out of the equation. So I say you stay away from it. Again, be careful what you wish for, because if you do cut rates, yeah, you might move the 2-year yield down to where you think you want it. But that 10-year yield, in my opinion, is going to stay stubbornly high. And the re-steepening is going to take place again at the wrong time. Just my opinion. And Liz talks about it all the time. It's not the basically inversion that gets you. It's the re-steepening that gets you. So if you're looking for, if you're wishing for a rate cut, again, I'll say it for the 100th time, be careful what you're wishing for here.
No doubt. All right. So this got me thinking about something. We talk a lot about these kind of fast food restaurants, you know what I mean? And how
McDonald's have, it's amazing. And I'm sorry to cut you off, but
get in there.
McDonald's having to defend themselves.
Yeah.
Hey, we didn't raise prices 100%. We only raised them 4. It's like, really?
Yeah.
You really want to play that game? Yeah. So listen, they're fighting against, apparently there were a couple McDonald's franchises that raised prices significantly in the market, or I want to say the media took it and ran with it. So McDonald's is trying to walk it back, but in walking it back, all they're doing is illustrating the fact that prices have risen significantly over the last couple of years.
Yeah, I mean, listen, this is a situation where, it's obviously wages, it's obviously
it's a lot going
food
on.
inflation, it's transportation, it's a whole host of things. And like, if you're a publicly traded company and you're a CEO of that company, you have a fiduciary responsibility to manage your business. You know what I mean? Like, the stock's getting punished for, what they tried to do is push through the costs. And now they've had it, like you say, backtrack a little bit. But this got me thinking about a name that I think is really interesting. So I want to look at Shake Shack for a second here, trading at $94. Expected GAAP EPS growth for this year and next, 45-ish%, 15% expected revenue growth, trades at 128 times this year and about 93 times next. Margins are about 47-ish% or something like that. You see that huge gap from, earlier this year. Stock has held those levels. You see it's back at a support level. But Guy, before you comment on that, I want to kind of just highlight one reason why we're talking about this. I got an email, as a good Shake Shack customer in my inbox this morning.
From Shake Shack?
Yeah, from Shake Shack. We're going to pull it up here. And I just want to get your, this is what the email was.
All right, hold on a second.
It says, get a free strawberry shake. Okay. For all you Mets fans. That's what it said.
So they're going to give away 7 shakes. No, no.
You think that was the calculus? They
well, no, I mean,
about
it's not going to move the needle.
Now, can I ask you a question?
this
all right,
stop.
All right, I know.
It's such a good move.
I know.
Okay, so here you go. I mean, Darryl Strawberry, good for Straw, have his number retired, probably long overdue.
He won a World Series
with the Yankees. Yeah, and the Mets as well. No, it's fine. No, it's great. That's clever. I think it's dumb as shit. I'm sure there's some bullshit Shake Shack out there that
they
more
have
people
one in center field.
That more people will probably be at than actually watching the game.
Yeah.
And yesterday, if you're a Met fan, and again, you did this for no, it's all good. I mean, you think about how shitty they are, and then you look at yesterday. Yeah. Edwin Diaz, who the best closer in the history of baseball. Yesterday they put him on the whatever list. I don't think it's called disabled list anymore. It's like whatever they call it, because they shoulder impingement bullshit. The guy can't get anybody fucking out this year. Number one. So they can't sit him.
Yeah.
And they can't pitch him. So you know what we're gonna do? We're gonna say he's hurt. Makes a lot of sense. Then Pete Alonso gets hit in the hand. He's out for the day. They drop 2 to the friggin' Dodgers in embarrassing way, right? And then they come back and they bring this guy in from the pen. I don't know what his name is. I should know, Lopez or something. Okay.
Lopey.
They basically bring him in mop-up duty.
Yeah.
He gives up a bomb to Ohtani. Next guy up, I think, is Mookie Betts, who check swing, clearly a check swing. The catcher checks for the third base umpire. The umpire says he didn't swing. For whatever reason, this Lopez guy starts giving shit to the third base umpire. The third base umpire tosses him.
You're out of here.
On his way to the dugout, not the umpire, the pitcher, he takes his shirt out and he throws his glove into the stands. Fucking embarrassing. Yeah, that's the Mets. That's the Mets.
Hey, Pat McAfee,
that's the Mets.
If you're watching,
no, they're a horseshit. He's not watching.
He would be
they're a shitty. And if you're a Met fan, you know what? I'm sorry about that. They're a shitty organization.
I did this,
and when all these people get traded, which they will, I mean, just enjoy. And they suck.
What do you think of the new owner?
And so Steve Cohen. He's not the new owner. He's owned the team for like 3 years now. Listen, it might as well be the fucking Wilpons because they suck just as bad.
I mean, this is.
I hate the Mets.
Now we need to.
And I'll say this.
We need
and
to have an E.
No. I'll say this as well.
An E.
And this, people have heard me say this.
Explicit.
This is factually true.
Yeah.
You ready?
Yes.
In order for the Yankees to get into the playoffs,
Yeah.
in order for I'm a Yankee fan.
Yeah.
Since the early 1970s. Okay.
Yep.
The good and the bad I've seen.
All of it.
For the Yankees to get in the playoffs, the Mets are playing a 3-game set with the Boston Red Sox. You follow me?
Yes, this is
hypothetical.
late.
This is hypothetical.
Hypothetical.
This is late in the year.
Yeah.
Maybe they got rained out in like May and they're making the games up in late September. So the Yankees need the Red Sox to lose to get into playoffs. Who do you think if the Mets play the Red Sox, the Yankees need the Red Sox to lose.
I get it.
Who am I rooting for?
You're rooting for the Red Sox.
I'm rooting for the Red Sox. And people say you're a lot. No, I'm not. The Mets could play the Chinese national team.
Yeah.
You know who I'm rooting for?
Chinese.
The guys in red.
Yeah.
100%.
All right.
And you'll be like, you're un-American. You know what? Fuck you. No, I'm not.
All right.
So they suck.
Holy Jacob, let's get that edit.
No, I'm sorry,
my
Jacob.
bad.
No, but you put up that strawberry thing.
I know.
But that's the Mets. You got to give shit away to get people to understand.
A lot of folks.
By the way, a lot of fans
understand
dressed
this
as
game.
empty. A lot of fans dressed as empty seats at the game yesterday. Just saying.
Oh, that's a good one.
No, well,
you know what, Jacob? Leave that in. All right,
Hockman
guys.
is laughing, right, Bill? You know what I'm talking about.
Oh my God.
There's nothing.
Could you do
about
this
the
on
Mets.
Boomer and Geo? Could you
Without
do
the
it all
cursing,
the
I've done it
F-bombs?
before.
Yeah, I would love to see that. All right, really quickly.
They suck.
I think many of you guys.
By the way, the Yankees are 19 games over.
Yeah,
they're
they're
just
doing
going
great.
about their business.
Yeah, business life.
By the way, the Yankees without Garrett Cole, who was a Cy Young winner in the American League last year.
Yeah.
The Yankees without Garrett Cole are 19 games over. Okay, just so we understand.
Yes.
I mean, they're trotting people out there that most of these guys have never heard of, and they're just mowing people down.
Yeah.
As a matter of fact, Dan wants to get out of here so badly. As a matter of fact, I think now they're on to 16 straight games where their starters have gone 5 or more innings, which is unheard of in Major League Baseball these days. Anthony Volpe, I think, is a 22-game hitting streak.
Stud.
Love the kid.
Yeah.
Anything else you want to talk about?
No, that's good.
The Rangers play tonight.
Yeah, Game 5 in the world's most famous arena.
It is the world's most famous arena.
All right, really quickly, we launched this Market Matrix podcast.
There's no cursing on the Market Matrix podcast.
MRKT. Yeah, it's written or read by Brunson, and he doesn't
curse.
No, he doesn't curse.
I curse.
So it's our new AI generated podcast. Guy and I and our team, we curate what we think are the most important stories of the market day, and then we pump it into Perplexity, and then we put it into 11 Labs, which is the voice bot. And you know what? You get this really good podcast in under 10 minutes. You go there and you are going to be able to kind of get up to speed on what happened in the market. So here's the deal. We want people to find this podcast. So if you could go to the podcast store, rate, review, follow, take a screenshot of your review.
Sure.
Send it to contact@riskreversal.com.
Blow up Amanda's. I love that.
Send your size, your mailing address, and you're going to get one of those tricked out t-shirts. So we really appreciate it. Check us out. Check out the pod. Leave us the feedback. Send the email. Get the shirt. Keep listening to the pod.
That's a lot of good things happening.
All right. We got a lot of stuff. We had a really interesting conversation yesterday with Kyla Scanlon.
She's follow her on Twitter.
She's awesome. She's going to be
on
the Tape podcast. She just wrote this great book, and it's really like a how-to markets in the economy and all this stuff. And we had a great conversation with her. Danny Moses is about to walk in here. We're going to have a
demo.
We're going to have a fired up.
Well, if you bring up the Mets again, we will.
I will not. That was just for the market call. I know. No.
But
hey, listen, people, we appreciate you being here with us these last 3 days in a holiday shortened week.
I absolutely appreciate
CME
it.
Group. We appreciate FactSet.
And if I've offended Met fans, too bad.
I really do it without the F-bombs.
It's better.
You can offend them without the F-bombs.
I get worked up. They say people of high intelligence curse
the
a lot.
F-word a lot. Yeah,
I don't know.
But
Maybe
the only
I'm
thing,
the
if you're running a podcast in the podcast stores, if you say that word enough, they put an E next to it. Not safe for kids. Explicit.
How do they know? What do they
have algos.
They have algos.
Yeah.
So maybe so before we put it in a podcast store, bleep it
let's
out.
Let's clean it up, Jacob.
Jacob can do that.
He will do that. All right. Thanks everybody. Thank you, Guy Adami. Hopefully we exercise.
I bet you Strawberry's watching right now too. Straw.
Is it? I think Doc Gooden is sick.
Yeah.
Someone told me
he's been sick for a while.
Yeah. All right. Well,
no, look.
It was amazing how they both ended up on the Yankees and some good teams. On the
Steinbrenner used to really like to ram it up their ass. No, he did. He loved nothing more than bringing like old Mets over.
Yeah.
I mean, David Cohn. There are a lot of them.
David Cohn, yeah, and winning some championships.
It made him so happy.
All right, peeps.
And Met fans hate, like, as much as the Mets loved 2 years ago under Buck Showalter.
Yeah.
And I know this to be true. There was a part of the Met fandom that really it got under their skin that Buck Showalter was the manager because he's a Yankee.
Yep.
They hate anything.
What was that early 90s? He was
the Yankees. He left in 95, I think.
He left the year after the strike.
And then Torrey came in.
They had those great years. They won in 96.
Or maybe Torrey came in 95, whatever.
They won 97, 98.
But
oh, no, they didn't win in 97.
Buck was the architect.
They won 98, 99, 2000.
96,
they beat the
98,
Mets in
99. In 97, they lost to the Indians at the time.
Do you remember there was a
that
game?
Was the shit?
Do you
remember the Flies came out?
Yes, and I remember a game in that series. I was there, okay, where there were back-to-back home runs. Do you remember that? 3 in a row by the Yankees.
I bet you it was like Dave Justice. I'm guessing now. I wonder who.
I think it was Bernie Williams. Was
Bernie,
one of them. And
O'Neill and Justice.
Yeah,
I got to go back and look.
That. We're going to figure that out. We'll update that on Monday.
Why not?
The market call. All right, thanks everybody. We're out of here. We're going to clean this one up. We're going to clean this one up.
Go Mets, LGM.
All right, bye guys. Thanks.